Hi, Professor Barati here. I'd like to go over some basic concepts of absorption costing in our cost accounting class. Please forgive the handwritten note. I have to confess I was in a very boring business meeting, and on my pad I wanted to look busy and look like I was taking notes. So I decided to draw up this what should be a PowerPoint slide of absorption costing for our class. It would be a much better use of our time and my time. And so here we go. So absorption costing. Essentially, absorption costing is basically the concept that could be replaced with this following term. How do we come up with the cost of goods sold in our income statement? We do it by using absorption costing. So the purpose of absorption costing is to create a methodology to determine our cost of goods sold. As we know, our cost of goods sold is a balance sheet account. And before our balance sheet inventory becomes a cost of goods sold, our cost must flow through our three inventory accounts: raw materials, work in process, finished goods. Once the goods are shipped to our customers, the product is actually shipped, we then recognize the cost. So we have the old GAAP principle from Accounting 101. Cost recognition is matched with our our revenue recognition. So basically the purpose is to come up with our costs. So think of one, our goal here is a product, which is our cost object. So let's say our product is we're building a house. We're a housing contractor and we have a house to build in our town. So our cost object is our home or house. Basically, underneath that house, we are gathering manufacturing costs. The manufacturing costs, which basically represent the cost of goods sold. This is a cost pool. What goes into the manufacturing of a house is direct manufacturing costs and indirect manufacturing costs, also cost pools. Direct manufacturing costs throughout our tax and our costs are almost always direct materials and direct labor. So the cost of building or making a house is going to be the wood and wood-related products. It's going to be steel beams. It's going to be all the components like windows, flooring, gutters, a roof, and even right down to the hardware of equipment such as the furnace, which we buy as a finished good from a contractor and install it, appliances, cabinets, and so on. Direct labor is going to be all the skilled labor and construction labor that we hire to make the house, including landscaping and so on. So direct labor are all the builders. Then another cost pool is what we call indirect manufacturing cost. Indirect manufacturing cost consists of two types, a variable overhead and a fixed overhead. Let's take variable overhead first. In building a house, we're going to have some indirect manufacturing variable costs, such as variable indirect labor and indirect materials. Indirect materials in the building of a house could be items such as nails, staples. These little objects that we don't keep inventory and it would be far too costly for us to track every nail or every staple or every piece of glue or compound we use to help put together the building product. So we might be building a deck. We obviously, the wood and certain supplies that go into that deck, the laminate and so on, could be easily traced and assigned right to that deck. But do we really want to count every little nail, every little compound that we use to assemble that deck? Most likely companies don't do that. So they buy these small little items like pins and tacks and so on, and nails and screws. They just basically buy big batches of this, and they cost it out right away. It doesn't flow through WIP. It just goes right into WIP as an indirect manufacturing overhead as a variable cost. And so they do start out as materials. We buy them as materials. And then we basically assign an overhead rate, as we learned, a variable manufacturing predetermined over rate. We include those in that rate, and we assign it, apply it actually, as a debit to WIP. And that's variable manufacturing overhead. Fixed manufacturing overhead, again, in the case of building a house, could be the salaries of the supervisors or the engineers or the architects on site to supervise this project. Fixed overhead could be even something like, if the project is going on for a lengthy period of time, we obviously have to have portalettes or porta potties for our workers. So we'll lease those and put it on the grounds. We'll also have to have the big waste management shipping containers for us to throw all the waste and excess wood and things that we're not using into our bins to be carted off. So that you'll usually see at a construction site or a housing site, a big waste container. That's usually a monthly rate that we lease from say a United Rentals company and gets hauled off. That's not really a direct material or a direct cost at all. It's indirect. It's needed to build a house, so we do cost it to the house. It ends up as a manufacturing cost and a product cost, but it's a fixed monthly lease. So let's talk about the cost behavior behind these as well. Direct materials and direct labor are going to be variable costs, meaning they move in direct proportion to the volume of the product we are making. So if we're building 3 houses on this complex instead of 1, and depending on the square footage, we're going to use direct materials and direct labor based on the volume that we are producing. It could be based on square footage of the size of the house or the number of houses. Variable overhead tends to be variable, but you will also notice in the text and the chapter that you've read that many variable overhead items, or many overhead items in general, may indeed behave as semi-variable, which is a combination of fixed or variable. Most cost accounting systems do not have a semi-variable feature, and they really don't know how to allocate that. So we're forced to make a decision on our indirect materials to treat them as variable or fixed. And so, in general, indirect materials will behave as variable, similar to our direct materials. Fixed overhead is exactly what it says. It's fixed. It does not move in proportion to our variable costs, except the relevant range concept comes into play. If we have to build, let's say, many more houses, we might have a relevant range rate issue where our fixed costs may go up. But in general, fixed costs for our purposes will be constant. They will not change with the level of production. Absorption costing is GAAP. So in other words, if you're producing generally accepted accounting principle income statement, you must use absorption costing. That is, you must use direct materials, direct labor, your variable overhead, and your fixed overhead allocated to your product cost, and your direct manufacturing cost to your product cost. Variable or fixed costs that are non-manufacturing are below the cost of goods sold, below the gross profit line on our income statement, and are considered period costs and are in our selling, administrative, and marketing expense costs below our gross profit line on the income statement. So below our cost of goods sold or our gross profit are period costs. They do not go into the cost of our product in absorption costing. Contribution margin or variable costing does use a slightly different approach, which we will discuss in a later video. Absorption costing, again, is GAAP. It's really based on definition. What are product costs? Product costs are all manufacturing costs. Manufacturing costs are direct manufacturing costs and indirect manufacturing costs. The components of direct manufacturing costs are direct materials, direct labor, or any other components that we can directly assign to our product. Indirect manufacturing costs are costs that we cannot directly assign to our product. They are allocated. And we usually break them up as variable or fixed, primarily because we want to know the behavior of the two. So absorption costing is really a definition of manufacturing costs. When we get into contribution margin of variable, both will use the same costing, except variable costing is more behavior driven. How do costs behave when it comes to making a product rather than definition? Slight difference. One more point I'd like to make that is brought out in the chapter and appears on many quizzes and professional exams such as the CPA and the CMA exam. Direct materials plus direct labor equals prime costs. Direct labor plus manufacturing overhead, both variable and fixed, equals conversion costs. So try to remember that because it's often tested. The reason why we call direct labor and manufacturing overhead conversion costs is because these are the costs that are needed to convert materials into a final product. Raw materials do not become a final product on their own. They need labor and they need overhead to become the final product. And that's why they're called conversion costs. Thank you for viewing the video, and I hope you learned something. And again, hopefully I will have a lot more boring meetings so I can do more work for class. Thanks.